this is not a very common pattern, but when it does take place, you know what to look for. There are certain conditions, because of the precise conditions, it may be rare, but nonetheless, when it does pop up, at least you'll be familiar with it and know what to do when you see it on the auto chart as emerging or completed chart screen. The other thing that you want to know is that when point D shows up on your autochartist chart panel, it indicates the potential for a market reversal. Okay, and this market may be at its most bullish or bearish point, depending on the direction and whether it's a top or a bottom. And this could indicate that a significant retracement is going to take place, or a correction is going to take place. And the other thing about knowing where this particular level is it gives you a exceptionally good risk-reward ratio. If you know ahead of time where the market can turn or is expected to turn, you can get all your ducks in order to set up the next trading opportunity with an easily identifiable risk. So in this case, once AutoChartist identifies point D, your exit is really above point D if you're wrong. So the faster you recognize it and the faster you react to it, usually the tighter your stop can be. And in this case, a failure to hold point D means you're wrong, and you should either be sitting out or going the other way. All right, so again, that pattern failure is going to suggest a strong continuation of this up move, maybe in progress. So it could serve two things, either as a stop exit or as a re-entry into the long side. Okay, moving along here to another pattern. We're looking at the butterfly pattern, and this is a little bit different. This is a butterfly pattern on the emerging charts. You'll see that the market identifies these particular swings here, X to A, B to C, and it's looking for symmetry between A and B and C and some other point in the future. So it puts this big purple dot up here, pink or purple, whatever you want to call it, and identifies where the market can go. And in this case, it was pretty precise because a new low was made at that level, and the market then began a retracement point. Okay, you can also see that in these patterns, when these butterfly and these three drive patterns, that there tends to be a crimping of the trade, or more frequent swings, or I call them like bunching up the marketplace. So those two are characteristics of major turns in the marketplace when you see that kind of bunching going on. So that's important to watch. Now we're looking at some of the characteristics of this market, and that would mean that you see an ABCD pattern in here. Okay, that's significant to know because we already know what the characteristics of that is. You see that there's a convergence of Fibonacci extension ratios where this point D would be. In other words, you have an extension of A and B and B to C, so you see an extension move coming in here. So it's really a combination of previous patterns that we talked about. And basically, you're looking at this pattern. This butterfly is formed by two connecting triangles, basically, and that's really what this is all about. It's connecting these mini patterns here together into another pattern. So that's the key characteristic there. All right. Sometimes some people see M's and W's. In this particular market, you can see that there's a W taking place, and that it could lead towards even a more significant breakout if points A and C are taken out. And again, the beauty of working with a pattern like this is it looks like it takes a long time to form in here. This is done over 25 240-minute time periods. That gives plenty of time for AutoChartists to also be looking for chart patterns that are taking place. For example, this may be a channel pattern, or this may be a rectangular pattern. All right, and this may also be maybe a pennant or a wedge that's taking place. So if you can get a combination of the Fibonacci and the chart pattern identifying that something significant is taking place, and you can then have this price accuracy, this price activity, and this identification taking place. It's going to, there's no doubt it's going to help you become a better trader, because you'll be aware of additional breakout levels, and you'll be aware of additional target prices besides what AutoChartist gives you in the chart pattern section. Okay, now this point here, when you look at the emerging patterns and you see this purple level or the circle come up, it identifies a probable market reversal. Okay, and this when you see this reversal, again, it's going to help you determine a much better risk-reward ratio than you probably were looking at previously. And in addition, if you do get a failure to hold this level, basically if it drives through point B and continues to move lower, it's going to indicate that there's further downside action coming. So again, this pattern, when you start to see this market cluster up and form and bunch up like this, when you break, if you fail to turn this market at this level and it begins to move lower, you can look at the short side with confidence, because it gave it basically its best shot and it failed. So that's another thing that you want to look at with this pattern. Now, the last Fibonacci pattern that we'll look at before we move on to basic chart patterns and then putting it all together is this Gartley Fibonacci pattern. Okay, and this one here is also looking for, it's basically a visual and a graphic example of price and time symmetry. Okay, and it's comprised of 4 consecutive price swings or trends. Okay, you can see that you have this X to A to B, B to C, and now you're looking for this projection into this level. And if the market does reach this level and fail, then it's likely to continue down into these retracement zones or even further. So again, AutoChartist is going, when it sees this setup taking place, it's going to give you the projection in the emerging part section of the Fibonacci pane on the AutoChartist platform. So that's what you want to look for. If you're that type of trader that wants to know ahead of time, you want to go to those emerging patterns and see if something is taking place that you can take advantage of. If you're already long a chart pattern, say for example, if you're long a breakout of a channel and you have a target zone that AutoChartist provides you with, then you may want to go back to the Fibonacci patterns to see if there's additional reasons why you should exit at that target zone. So you want to combine the two. You want to switch back and forth and see if you can get some help as to why you should move out of the marketplace. Or if, say, you're long a market, a chart pattern that AutoChartist has identified, and you have a feeling that the market is beginning a correction, or it's starting to show signs it's given a correction, and you want to look at these Fibonacci patterns to see how much of a retracement you're likely to have, or how much your profit, or how much heat you're expected to take on a trade. So those are two reasons why you want to look at both your chart pattern and Fibonacci patterns together. Now, they may not always match up, but at least you have the opportunity to look in. If you didn't, and say you exited a good chart pattern, you exited on the first correction, you may not realize that it's a normal Fibonacci correction, and it could force you out of the market and prevent you from making even a more profitable move. So that's the reason why you want to do these switches and combine these charts. Now, looking at this Gartley pattern, it resembles an M or a W also. This pattern, bottom E action, so it looks like a W. And it contains an ABCD formation also. And usually this point X is a very significant high. So that's how that looks. Now again, too, this takes, because there's a lot of mathematics and symmetry involved in it, may not show up every day. So it may take time to develop. That's why when you do see it happen, then you want to be able to pounce on it right away, or at least know what it is, so that you can take advantage of it. Okay, a lot of times good patterns don't occur often, and so when they do, you want to take advantage of them, because it could mean that they're telling you something significant is taking place. Now, each turning point here, identified by these letters, they should represent a significant high or low on the price chart. Okay, and these points define 4 consecutive price swings or trends. It's important to know, and they make up the pattern's 4 legs. Okay, so you have these 4 legs here identified. All right, once you know where those legs are, then you can gain confidence that this market is indicating a possible reversal, and that could identify potentially higher probability buying or selling opportunity. So in this case, once you see that point C is formed, you have a high probability that this market's going to rally into this zone. And just to look at some of the background of this pattern, this represents a convergence of the Fibonacci retracement and extension levels at point D. And so again, once you see that, you're going to have a better confidence when you try to establish your risk-reward ratio. Okay, so that gives you the background of Fibonacci. Then we'll switch to another scenario where we're going to review our trending patterns. And our trending patterns, as we talked about in previous webinars, are your trading patterns are your trending and non-trending patterns. Okay, and this is before we go on to live data.